Have you ever wondered how to build a passive income stream? Well, you're not alone. It's a dream that many of us share, and for a good reason. Passive income, the ability to earn money without active, everyday involvement, is a game changer. It's like having an extra set of hands, tirelessly working to fill your coffers while you focus on other aspects of life. But how does one create such income? Is it even possible for someone who's not already rolling in dough? The answer is a resounding yes, and the secret lies in a financial instrument known as exchange-traded funds, or ETFs for short. Our journey today will take us into the world of ETF investments, demystifying the concept and teaching you how to use it to generate a steady stream of passive income. It's time to turn your financial dreams into reality. Ready to learn the secret to building wealth while you sleep? Stay tuned. First off, what exactly is an ETF? ETF stands for Exchange Traded Fund. Think of it as a basket full of various stocks, bonds, or commodities. It's a kind of investment fund that's traded on stock exchanges, much like individual stocks. But unlike buying a single stock where you're placing all your bets on one company, an ETF allows you to diversify your investments across a wide range of companies or sectors. Now you might be wondering, how does an ETF work? Well, an ETF holds assets such as stocks, bonds, or commodities and aims to track the performance of a specific index. For instance, an ETF that tracks the S&P 500 will aim to replicate the performance of that index. This means the ETF's value will go up or down as the index's value changes. So, what are the benefits of ETFs? For starters, they offer broad diversification. This means you're spreading out your risk across many different assets, which can help to protect your investment. Secondly, ETFs are traded like stocks, meaning you can buy and sell them throughout the trading day at market price. This gives you flexibility and control over your investments. Moreover, ETFs are often praised for their cost-effectiveness. Many ETFs have lower expense ratios compared to mutual funds. This is because most ETFs are passively managed, meaning they aim to track an index rather than actively trying to outperform it. Lower expenses mean more of your money stays invested, which can lead to higher returns over time. So why are ETFs a good choice for passive income? Well, many ETFs pay dividends to their shareholders. These dividends can be reinvested or taken as cash, providing a steady stream of income. Moreover, because ETFs are passively managed, they require little time and effort on your part, making them a great choice for those looking to generate income without having to constantly monitor and manage their investments. Now that we know what ETFs are, let's delve into how they can build your passive income. In the world of ETFs, not all are created equal. You see, the beauty of exchange-traded funds, or ETFs, lies in their diversity. They offer a vast array of investment opportunities, but not all ETFs are the same, and choosing the right one for you requires a bit of homework. Firstly, consider the expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It's calculated as a percentage of your total investment. While it may seem small, over time, a high expense ratio can significantly eat into your returns. So it's always wise to look for ETFs with low expense ratios. Next, take a look at the ETF's portfolio. What assets does it hold? How are they distributed? An ETF that's diversified across different sectors and geographies can offer more stability and is less likely to be impacted by a downturn in any one area. Consider your own investment goals and risk tolerance when examining an ETF's portfolio. Performance is another key factor. While past performance is not a guarantee of future results, it can give you an idea of how the ETF has managed in different market conditions. Look at the ETF's historical performance over the long term. Has it consistently delivered returns? Has it weathered market downturns well? Additionally, consider the ETF's liquidity. This refers to how easily you can buy or sell shares of the ETF. ETFs with higher liquidity are generally easier to trade, which can be a significant advantage if you need to adjust your portfolio quickly. Lastly, don't forget about the fund's reputation. Is the ETF managed by a well-known, reputable firm? Has the fund been around for a while, or is it relatively new? These factors can also influence the ETF's performance and reliability. By considering these factors, expense ratio, portfolio performance, liquidity, and reputation, you can make an informed decision about which ETF is right for you. Remember, the right ETF can maximize your passive income. So take the time to do your research and choose wisely. So, you've chosen your ETF, now what? Well, it's time to dive into the actual process of investing in ETFs. The first step is to open a brokerage account. There's a multitude of brokerage firms out there, each with its own unique features. Some offer commission-free trading, others have robust research tools, and some are simply known for their top-notch customer service. Research carefully, and choose one that aligns with your needs and preferences. Once your account is set up, you're ready to buy ETF shares. You can do this by placing an order through your brokerage account. The process is similar to buying individual stocks. You'll need to know the ticker symbol of the ETF you want to buy. It's a unique series of letters that identifies each ETF. Now you might be wondering, how many shares should I buy? Well, that depends on your investment goals and your budget. Remember, it's generally a good idea to start small, especially if you're new to investing. You can always buy more shares later as you get more comfortable with the process. Next, we come to an integral part of earning passive income: reinvesting dividends. When you own shares of an ETF, you'll often receive dividends, which are a portion of the earnings distributed to shareholders. Instead of taking these dividends as cash, consider reinvesting them by buying more ETF shares. This is a powerful way to compound your earnings over time. Lastly, keep in mind that investing shouldn't be a set-it-and-forget-it endeavor. It's important to monitor your investments regularly. Market conditions can change rapidly, and it's crucial to stay informed so you can make educated decisions about your investment strategy. And there you have it. You've opened a brokerage account, bought your ETF shares, and learned about reinvesting dividends. With these steps, you're well on your way to earning passive income. Investing in ETFs isn't a set-it-and-forget-it deal. Yes, ETFs are a fantastic tool for building a passive income stream, but they're not a magic wand. They need attention and care, just like any other investment. Now you might be thinking, I chose passive income because I didn't want to spend my time managing investments. That's a fair point, but managing your ETF portfolio doesn't have to be a full-time job. In fact, it's more like a biannual dentist appointment. It might not be the highlight of your year, but it's crucial for your financial health. Let's start with reviewing your portfolio. Twice a year, take a look at your ETF investments. Are they performing as expected? Are there any new ETFs on the market that might better serve your financial goals? This is your opportunity to make sure your investments are still aligned with your objectives. Now let's talk about rebalancing. Over time, market fluctuations can throw your portfolio's asset allocation out of whack. Maybe you started with a 50-50 split between bonds and stocks, but after a year of growth in the stock market, your asset allocation is now more like 60-40. That's where rebalancing comes in. By selling some of your stock ETFs and buying more bond ETFs, you can bring your portfolio back to its original 50-50 split. Remember, the goal of rebalancing isn't to chase market trends. It's to ensure your portfolio continues to reflect your risk tolerance and investment goals. It's about maintaining control over your investments, even as the market ebbs and flows. So, don't think of managing your ETF portfolio as a chore. It's an opportunity to check in with your financial goals, make sure you're on track, and adjust your sales if necessary. It's about staying in the driver's seat of your financial journey, even while you're enjoying the benefits of passive income. A well-managed ETF portfolio can be a powerful tool for building passive income. There you have it, a step-by-step guide to building a passive income stream with ETFs. We've taken a journey from understanding what passive income and ETFs are, to choosing the right ETFs that align with your financial goals. We've looked into the essentials of investing in ETFs, from starting small to diversifying your portfolio, and then delved into managing your ETF portfolio effectively, ensuring you're keeping track of your investments and making adjustments as necessary. This process is a marathon, not a sprint. It requires patience, diligence, and a good understanding of your financial objectives. But with the knowledge gained from this video, you're well equipped to build your own passive income stream with ETFs. Remember, the world of finance is constantly evolving, so keep learning, keep investing, and keep growing. If you found this video helpful, don't forget to like, subscribe, and share it with your friends. Remember, a prosperous future starts today. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.